Hey everyone, welcome to podcast number 70. We're going to jump right into a very important topic, the yield curve. We have seen quite a bit of movement this past week, and we want to address what it means and just some questions that people have about the yield curve. It's really one of these things that is very important, but so few people understand it and how it works. So let's just dive right into it right now. We did see the tens and twos. So when we talk about the yield curve, we're going to be talking about the tens and twos. So the 10-year yield minus the 2-year yield. And so we saw it bouncing off the lows this past week. And it's not the first time we've seen it. During the SVB collapse, same thing happened, except obviously much quicker because that was a big catalyst for deflation when that happened. And we're not seeing any catalysts now, but we are seeing movement. So Gamma, why are we seeing this movement? What happened this past week that caused this?
So number one, obviously we had the jobs report come in, right? And the jobs report, let me first clarify why the yield curve is moving the way it is. We're not seeing, so typically on yield curve reversions, right, when the yield curve or the spread, right, goes up, which is the spread between the two. When that goes up, it's typically a sign that front end rates are coming down faster than long end rates. Well, what's been happening is the longer end has been slowly lifting, where the front end is not moving as much. So what's happening is basically yields are stabilizing essentially at the current level of where they are, and the back end's getting lifted up as rate cuts, or I should say, the duration of expected policy is being extended further into the curve. We'll talk a little bit more about that and why that's important. But what that's telling you is the Fed is expected to hold higher for longer, and the back end of the curve, therefore, is being lifted. But because the Fed is not cutting right now, the front end of the curve is glued. So what you're getting is a semi-reverting yield curve without the recession. But it's going to be almost impossible, in my opinion, to see this actually do a full reversion in terms of like actually going positive and really steepening without that recession.
Right, because the reason for that is because the 10-year would need to double for it to really go back to normal levels if we assume that the 2-year yield stays the same.
Well, yeah. So to get back to normal levels where we're talking, at least a 50 to 60 basis point positive spread, right? That's at a minimum. We'd have to move up at least 130, 100, whatever, 140 basis points from here, right?
Right.
Yeah, or at least 80 basis points at a minimum, right? We need to go up 80 basis points.
Yeah. So to really get the true normalization of a yield curve, you need the Fed to cut rates.
Right, because otherwise what ends up happening is you have this idea, right? Which, trust me, it's going to start happening, where people are going to say, you know what? The new neutral rate is not 2%. It's 4%. We're going to stay at 4% in the long end of the curve. So the reason the long end of the curve is higher, right? And it gives it in a normal yield curve, it gives you more yield, is you're taking on duration risk like anything else. If you're going to make a loan that has a term of 1 year and a loan that has a term of 30 years, the 30-year loan you're going to lay that money out for, you're going to want a higher interest than that 1-year loan. Well, in an inverted yield curve environment, it's all backwards, right? You're getting paid more for making shorter term loans to the government than you would longer term. Now, when the yield curve reverts, what happens is that inefficiency flips back to normal, where the long end of the curve becomes the higher paying, or I should say, the long end is the higher paying tenor, where the front end is now cheaper. So what happens here when this type of yield curve reversion towards zero, like we're seeing right now, when the front end isn't moving, it's assuming that the baseline is going to be that 4% that we're sitting at right now on the a little bit higher, excuse me, like at 4.8% on the 2-year.
Right. Well, so how long could we really stay at these levels?
Well, that's interesting because yield curves can stay inverted for a lot longer than a lot of people think. And the reason behind that is you have two factors like we were just talking about, right? So you have the Fed controlling the front end and the economy controlling the back end. So the back end is moving up because we're not seeing a recession. Now the front end is pretty much glued to what the Fed is doing. That's why the twos and tens are a nice indicator, because the 2-year has a larger control or a larger emphasis on Fed actions, where the 10-year is more market based. Obviously, the Fed affects all tenors, but the the 2-year is more significant. So when you look out on the curve 10 years, what you end up seeing is you end up seeing the more growth effect and longer term inflation effects than you do on the 2-year. So when the 10-year starts rising, it's more significant in this scenario because it's giving the idea to the market that the recession isn't here. Now, you might you might be thinking, well, the yield curve reversion is a recession. Yes, it is. But you need the actual reversion to occur where the front end gets lowered. And that's pretty much how reversions have happened historically. And that's how I think the real reversion would happen. Again, right now we're just kind of seeing some chop, and it's not something that's really going to be significant in terms of the duration. So the duration doesn't really play so much of an the duration that the yield curve is inverted is not as significant as one might think, or even the level that we're inverted to. Right? Just remember, we're at some of the steepest level, or I should say deepest levels, right, in 20, 30 years. But we're also in one of these inflation environments that we have not seen in a very long time in terms of that rapid acceleration of inflation and policy action from the Fed. That's going to basically mangle this yield curve a lot. And it's going to put us in a position that we haven't been before or haven't been in a long time. And that resolution is going to happen in a way that we haven't seen before or haven't been in a long time as well. Now, that doesn't mean we're going to go into the Great Depression. It just means that the way things unfold aren't going to be as predictable, right? Like, that's just how it is. Like, this entire move down was pretty predictable if you decided to avoid bonds and stock and just sit in cash. But for the regular bond buyer, this was torture on the way down. The recession was supposed to be here every month for the past 12 months.
Yeah. Well, so going back to your point about the Great Depression, seeing a yield curve this inverted, like we haven't seen this in over 30 years now.
Right.
And I'm seeing a lot of people saying that this means the recession is going to be deep. If the yield curve inverts this deep, then the recession is also going to be deep. Is that really true? No. And like, why would that even hold true?
Okay, so people like what people like are simple things, right? We all know that. We like simple things too, to a degree. Everybody does, right? Something that's, you can look at the chart and say, easy.
Yeah.
But if you take the twos and tens, right, and put them on this chart, and you'll see in red right here, these are the recession markings. Okay. What you'll notice is in 2007, 2008, the yield curve, the twos and tens didn't even clear negative 20 basis points. Or maybe it did for a day, right? And that was a pretty deep recession, I would say, right? 2008, the GFC.
Yeah.
That's pretty significant, right? Yield curve wasn't even reverted for that much or that long. And let's just take, for example, 2001, 2000. That was a pretty deep inversion. We went almost negative 50 basis points on the twos and tens. Yet, it almost seemed like that recession was much shorter than 2008. So, and obviously, you can look at here, in 2020, the COVID recession was very, very minimal, and that's because of all the stimulus that happened. And to answer your question, it doesn't seem, and wouldn't really make sense that there would actually be a correlation between the depth of the yield curve and the duration of the recession, right? Or I should say the deepness of the inversion and the duration of the recession, because there's more factors in, like everything else, we can keep everything simple, but we have to expand and open our minds. There's more factors to every recession, right, than anything else. And we can simplify this. We can simplify this whole thing down to seasonality traders, people that think like, oh, I'm going to trade seasonality, right? Like April's a good month for stocks, or whatever, August is a bad month for stocks. I'm just making a months up. Whatever the averages are, I'm just giving you an example of the seasonality effect, where people want to be long these months, short these months, whatever. Long story short, what I'm trying to explain here is you're basically comparing a bunch of dependent variables, right? The yield curve and the recession, they're both dependent. There's no independent variable here that you're isolating against these variables. And what I mean by that is you don't have any anchor. Because we get a recession and the yield curve's inverted, that doesn't really mean much, because the yield curve is inverted because growth is basically getting shot on the back end of the yield, or I should getting is depressed on the back end of the yield curve, and while the front end is either being hiked or remaining constant for whatever other reasons. So there's other factors in here. One of them being growth, right? Growth would be a dependent variable in this scenario. Growth would alter both. The independent variable, excuse me, would alter both the yield curve and the recession. Growth matters in both these scenarios, where either we can look at this chart and we can basically debate which one matters to which one's related to which one, how each one moves. But in reality, growth is the key. If growth decides to shit the bed from here, we'll get a recession and we'll get the yield curve reversion. So it's really just, it's a matter of how these things play out. And I don't think you're going to be able to time the depth of a recession in terms of growth by just looking at the yield curve. It's kind of the yield curve itself is only this inverted because of the Fed and the way the Fed's hiked rates and held them for and basically hiked them so aggressively in such a short amount of time.
Yeah. Well, so to a regular person looking at the yield curve, at what point is it kind of, like a panic area? At what point does a reversion get considered a reversion? Is it once we get back up to zero, to that zero line? Or well, would it be possible, since we're so deep, that it's kind of a reversion would be considered, negative 0.4%? Is that a possibility?
No. So when the yield curve fully, so you have to understand the dynamic we're in, right? We're in a situation where the Fed is going to, in the sign of a recession, of a real recession, the Fed will cut interest rates. That's what they're going to do. They're not going to hold rates into a depression. Is it possible to remain in a slightly inverted yield curve for years? 100%. The way that would happen would be, you'd have to have the Fed not ease during a recession and remain completely restrictive permanently throughout a recession. Which then you get into the situation, like, for example, if growth slows, let's just say we get, GDP down to negative 2%, right? Negative 1.5%, negative 2%, and continuously falling. And the Fed is still holding rates at 5% consistently. And unemployment's, 10% now, and the Fed's still holding rates at 5%. It's not going to happen. But in that scenario, yes, the long end would get itself the long end would drop like a rock, and the front end obviously would be stuck because of the Fed. And what you'd end up having happen is the long end would realize that the Fed is not going to cut rates if in that scenario. This is hypothetical, right? And the long end would actually start lifting up again because it's realizing that we're getting no rate cuts.
Okay.
And
so it's almost an impossible scenario. Like the Fed would have to be fully negligent towards the economy.
The Fed would have to go full retard.
Yeah.
For that to happen.
Okay.
Yeah. Like,
so that's not really something that's in the books.
They've done some really stupid things, but they would have to go full retard to pull that off. I mean, I'm talking about, like rudimentary economic concepts are thrown out. Everything just garbage, gone. Like, I'm talking about, like, you take a person off the street and make them the chair of the Fed type of thing. Like, that would have to happen.
I could almost see it being somewhat possible, obviously not to that full extent as your example, but I could see them holding off during a deflationary period, unemployment rising, and just holding off to really make sure that they don't get themselves into a 70s situation again where inflation rebounds because they cut too early.
That's possible. That I can see happening. And, like, remember, so the front end we're talking 2 years, right? So if the Fed, if the market really does go to hell in a handbasket, the 2 years is going to a degree, front run the Fed to a degree. It's not going to do it all by itself, but if the market starts pricing in Fed rate cuts, the 2 year will move. It will be then the Fed's job to come out and invalidate those rate cuts to keep the 2 year pinned, right? Yeah. Because the Fed realistically, after even 12 months, has the effects from the Fed wean off, because the Fed can control short-term instant interest rates, the ones that we experience now, not the ones that we will experience in 2 years, right? They have to basically come out and commit to holding rates from where they are right now to where they are expected to be in the next 2 years to keep the 2 years stable, which it's easier for them to do that than over 10 years. That's why the 2 years is a better indicator. And it's also long enough. The reason the 2 year is used instead of 3 months, a lot of people like to use 3 months. Well, 3 month was garbage the last year because when you use a 3 month a treasury bond in the spread here, the 10-year 3 month, you're only getting the next 3 months in your window. And we were hiking at the fastest. We basically hiked 500 basis points in 12 months. So
Well,
there's no way
the
that
3 month
3 month
was also affected
was
by the whole debt ceiling issue as well, right?
yeah, there you go. Yeah. So there's so many facts. That's why we stick to the 2 year out long. It's not the middle, obviously, of the curve, but you leave a lot of the front end garbage off and you cut a lot of the back end garbage off for both of these 2s and 10s. You get like the middle, even view of the market. So that's why we look at that. But in terms of like what the Fed, to go back to what you were saying, the way the Fed's going to approach this, just know that we had the minutes come out this week, right? So the Fed basically came out and said that they see a mild recession likely to start later this year. And they also said that inflation expectations remain a key to the policy outlook. So what they're basically telling you is inflation expectations currently remain well anchored, which we know we track them almost every day. And like everyone else is thinking, the Fed is expecting and going to cause a recession. The problem here is, and I want to get into like why this is so important, is this idea that the Fed is going to need to destroy the jobs market. Obviously, the reason I bring that up is unemployment rate came in this week at 3.6%, lower than the 3.7% of the prior reading. So again, lower unemployment rate, something everyone says the Fed does not want to see. The Fed wants more jobs off this market, or basically they want to increase the number of unemployed people. And NFP, on the other hand, though, did come down, and these are two different. Obviously, NFP and the unemployment rate, they're not the same. So what I mean is they're not the same data series. So when you see NFP come in lower than expected, but the unemployment rate goes down, it's because they're derived from two different surveys. So that's why many people get confused, like, oh, they're rigging the system. Oh my God. They'll say like, oh, the data is rigged. The data, first off, there are revisions to the data. So the data is not 100% true. And every year, this year on NFP numbers, up until this point, every month this year, up until this point, the NFP numbers have been revised downwards prior to their release, meaning that we came in at 209,000 jobs added in the month of June. There's a very high chance that number will actually be revised lower by next month, or in the next month or two, meaning that we probably didn't add 209,000 jobs based on obviously what's been going on so far this year in the jobs report numbers. But the JOLTS, on the other hand, they're back below 10 million. So the JOLTS, again, in terms of the job market, they're telling us that job openings are decreasing. Now, why I bring this up, the jobs report and this whole concept of the Fed, is because everyone's saying the Fed is going to go until they break the labor market. But we have to pay attention to the bigger picture here, the soft landing, right? Now, we believe soft landing is impossible. The Fed believes the soft landing is impossible. The reason the Fed believes the soft landing is impossible is because the Fed is founded on two principles that make the soft landing impossible: maximum employment and price stability. Their mandate is the Phillips curve, right? The Phillips curve being as you increase unemployment, you decrease inflation, and as you decrease unemployment, you increase inflation, inversely correlated, which we know has been disproven over times of low inflation and low unemployment. Throw that out the window. It doesn't matter. The Fed still believes it. So this is why it's important. So if the Fed sees that inflation is coming down, which it has been, if it continues to stay moderately low and trend lower, the issue that you have now is the Fed's going to sit there and say, well, did we just achieve a soft landing? Now, you might be thinking, oh, no, the Fed wants unemployment up above 4%, whatever nonsense you listening to or believing, doesn't really matter. The Fed just cares about price stability.
Right. Employment's they have half the equation under control right now. It's the inflation part of the equation that they don't have under control. So once they get that under control, and unemployment is still under control, they're going to stop. Why keep hiking if you're in
Right.
that situation?
And a lot of information you get from them, right? So if as you listen to these Fed speakers come out, and even Powell, right, you're hearing them say a lot of things like, "We think further rate hikes are still necessary, right? More on the table, and we expect another 1 to 2 this year," right? They use this. They always the Fed will never put themselves under the gun like this
Yeah,
because
yeah. Is it just me, or are they just way more hawkish now than they were just 6 months ago?
no, 100%,
Yeah, like
100%.
while they were hiking, they had the whole we're going data dependent. They didn't want to scare the markets, even though I believe they knew exactly what they were planning to do for the whole time. They were planning on raising rates that quickly from the beginning, but they weren't nearly as hawkish as they are today. Back then, they were trying to keep the markets calm, and
Right,
now they're
right.
coming out and being more hawkish than ever before when we're at the end of their hiking cycle.
Right. And I know what you mean by that, right? The end of the hiking cycle. Like, it doesn't mean we can't get like another 1 or 2 rate hikes. It means the majority of the work's already done,
Yeah,
right? That's what
exactly.
that means. Right. So I think that the key to that is that the Fed didn't say we're gonna hike at the next meeting. That's not what they said. They said we expect 1 to 2 more rate hikes this year. That could mean in December, in September, it could mean whenever, right? At the end of, up until the end of this year. I personally don't think the Fed is going to hike rates at the next meeting. I know that sounds crazy, right? We're looking at a 92% chance of Fed hiking rates. I and I can get this dead wrong, but there's reasons fortunately for me, if I get this dead wrong, it won't make a difference in terms of our model positioning and everything, because everything that we do is database checks. It has checks and balances. It's not just my opinion. I don't wake up one morning feeling a certain way. I'm going to buy bonds, or I'm going to go short the SOFRs. It doesn't work like that. It everything's checks and balances. So my opinion on what the Fed is going to do isn't going to directly hurt the model or our positioning. But I do think that the angle the Fed took in the last week, or in the last meeting, I'm sorry, was the approach of saying, okay, we've done so much. They've stated numerous times, and a bunch of members have said this, that they are still uncertain about the lags in policy. And they want to take it, not me, meeting by meeting is probably the right term to use. And they want to basically let that policy action absorb into the market. So if that's their way of doing it, and they're going to go meeting, hike every other meeting, if that's the way they want to do it, they could certainly do that. But I also don't think that waiting one meeting is enough to basically decipher all of what they've done. Meaning, if they weren't going to hike at last meeting, and they've done so much, apparently, it's what they're telling you and what we're seeing. They are restrictive from the way, based on what we're looking at the market, they are restrictive. So if they are restrictive, they've done so much. Why would they wait one meeting? It's only one jobs report, one CPI report, one of pretty much everything, right? Maybe outside of GDP. And I'm talking about final report, right? Why would they do that and just wait one report and say, you know what, we need to hike more? Because we already know that inflation is going to come in lower in June. Because we know that we still have those base effects from last year. The Fed knows this too. Everybody knows this, right? Inflation has been having basically tailwinds to the downside for the last 6 months, which is why it's dropped so quickly. And expect bounces. That's normal on a way down. We don't go from 9% down to 2% in a straight line. Expect some bounces. But long story short, the Fed knows this too. So what are they waiting one meeting for?
Yeah, it really just doesn't make sense to just pause for one meeting and then hike the next when
Nothing's changed.
yeah, nothing's changed. There hasn't been new data that came out. There is the unemployment rate, which people are holding on to, and that's pretty much the only reason that people have to justify another hike. But the unemployment rate doesn't matter if CPI is coming down, as you said.
Right. Like, let's take a look at
if
inflation.
if
Right?
if the unemployment rate is fine, which is one of their mandates, so that's good. It's in line. The only thing that's not in line is inflation, and it's coming in line. why raise more and risk destroying the employment situation if the inflation situation is already coming under control?
Right. And we know that the Fed is very focused on core PCE. They've made it very clear, right? Very clear they're focused on core PCE, but headlines down to 4%, right? So let's look at PCE core, right? Let's look at this. This is down at 4.62%. This is pretty much holding sideways. The Fed's at 5%. They're above core. Technically, the macro aficionados would say the Fed's in real positive territory because they assume that the real positive rate is this Fed funds rate minus the core PCE rate. And that's mainly because the Fed has built a foundation on this idea that that's a proper way to measure real rates. When in reality, we have a lot of research that we've done showing that the proper way to do it is, or the more efficient way to do it is to use break evens. Long story short, the Fed is as restrictive as they are. The Fed right now is as restrictive as they were back in 2008 before 2008 financial crisis hit. So they're very restrictive. Most might not see that, and they know that too. And the reason that they know that, and you don't know that, is because you don't understand what they're saying. When they're saying inflation expectations remain a key to policy outlook, they're saying inflation expectations remain remarkably well anchored, right? When they say these things, what they're trying to tell you is that inflation risk is going down. And if the reason that the only reason that the Fed hikes interest rates, there's only one reason why the Fed will hike interest rates. One reason. And it is not to put people out of jobs. It is to manage inflation. The only reason the Fed exists is to manage the banking system and manage inflation. The reason we have an independent Federal Reserve in in the United States of America is so the government doesn't take their deficit plans or their spending plans and just turn the money printer on and just run away with the money. That's why we have the Fed. They control the money supply independently, to a degree, right? We all know things aren't as clear as they always seem. But because of that key, if unemployment starts picking up, it's usually not because inflation is ripping, right? Usually what happens is when unemployment starts accelerating, it's because we have deflation. Inflation is dropping like a rock. The Fed will then come and cut rates to stimulate the economy. But we're not seeing any of that. We're seeing the complete opposite way. Inflation is ripping, but unemployment isn't going anywhere. And the Fed likes to see unemployment pick up because, again, it asserts that their Phillips curve is working properly. We did our job. Maximum employment or price stability. Well, if prices are unstable, we have to break the maximum employment. That's the way they think. In reality, they're realizing, oh, darn, employment's not breaking, but inflation outlook remains remarkably stable. And we have people coming out on the some of the Fed speakers saying that we're on the golden path to avoiding a recession.
And
remember what I said.
That's exactly what they want people to think too, especially with their hawkishness as well. Going into this, they want to be hawkish as they're stopping their hiking cycle. Otherwise, a lot of the work that they did is kind of going to go to waste, especially since if everyone knows that they're done their hiking cycle, it's obvious, which right now it's not. It's murky, which is exactly what they want. If it's obvious, people are going to be buying houses. People are going to be taking out loans because they could just refinance because they know the Fed's going to cut soon. They don't want people to think like that.
Right. And remember what Powell said this a bunch of times. Powell has said that that policy statements can have a direct impact on future expected policy at a much faster rate in modern times, which is why
they're literally laying it all out in front of everyone, but people still don't get it.
but they can't, again, the Fed's not going to put them. The Fed, Powell's a lawyer. Remember that. Like, these people are good with their words. They are not going to put them. Like, Powell is not the. Let me put it this way. Powell did not make the Fed chair board or the chairman of the Fed by being a moron. Okay, he didn't just walk in there and throw darts at the board and say, "I won. I'm the new board member. Like, I'm the new chairman." Excuse me. That's not what happened. There's a reason that he is where he is. He is going to go down most likely as one of the best Fed chairmen that we've seen in a very long time, if ever. He's managed recession. He's managed deflationary recessions and now inflationary recessions. The guy's a G. Okay. The guy is
Yeah, literally.
unbeatable. Okay. Now, the question here is how this resolves. And more so, will the Fed continue hiking interest rates? I think they could. I think there's a higher possibility the Fed hikes later in the year than they do at the next meeting, in my mind. I could be dead wrong. They could come out the next meeting and just hike just to say, you know what? We want to maintain our basically here, we're maintaining our credibility. Hike. Told you more hikes were coming. Boom, done. But I don't think they've done enough research to justify being even more tighter than they are today. Like I said, you plot things out, they're at the tightest that they've been. Here we can take a quick look here. This is how we measure how tight the Fed is. If we take a look where they are right now, the Fed is as tight as they were back in 2000. And let's go to better view. The Fed is as tight as they were back in 2007. Okay. So if they're going to continue hiking from here, they better have a reasonable basis to believe that their hikes are doing nothing. We're already seeing the job openings come down. We're seeing inflation come down. Yeah, core PCE is sticky. Yes, if you did not know, core numbers are a subset. Core is a subset of inflation. By default, it is literally all the sticky factors of inflation. So it's a sub-index designed to be sticky. Of course, it's going to be sticky. Yes, we all know that. Okay, it'll be slower to come down like it always is. So theoretically, core PC doesn't really move anywhere close to as much as CPI does, and CPI is what most pretty much all the models on Wall Street run off of in terms of monitoring inflation. That's why we focus on headline CPI. Keep it simple. Long story short, the Fed is going to need more evidence, in my opinion, to really keep the hikes going. And if they're going to keep the hikes going, I don't see how an extra 50 basis points makes or breaks the system in terms of like, oh, yeah, we just did 50 basis points. We solved the inflation problem. We can go back to 2005, 2006, back when we were here when the Fed was hiking rates. Take a look at the FFR quickly. When the Fed was hiking rates back over here in 2006, they expected further rate hikes. Like they always do. The market is linear. People are dumb. People are stupid. Unfortunately.
Yeah. When people see rate hikes, they expect continued rate hikes.
Right. When they see rate cuts, they expect continued rate cuts. It's just the way the people, just like this, when they see a company that's beating earnings at every earnings, what do they think the company's going to do with the next earnings? Beat? It's that simple. It's just people are linear like that. Okay. And then like when it goes on a super hot streak, when they win 10 times, when earnings beat 10 times in a row, they're like, oh, they're going to miss this one. Then you get the guys that are trying to fade it. You first you get the really linear dudes that are just like, oh yeah, we're gonna just keep going up, and then you get finally after 5 or 6 times, we're like, oh, then you get the guys that are like, I'm gonna fade this. It's like the guys at the roulette table, right?
Yeah.
They're like, oh, this number is gonna, we're on a streak here. You got the guys that are like, this thing just keeps hitting red. All right, I'm gonna go red. Then you get the other guys like, oh, we're about to hit black. Meanwhile, the odds are neither. The odds are not more probable that this is going to happen or that's going to happen. The odds come down to this is a culmination of a lot of data, not just what the Fed funds futures are telling you. Now, we've been very adamant this last year about saying, don't fight the market. You have to understand what that means. That doesn't mean that we're sitting here saying this market is wrong. Right now, the market thinks the Fed's going to hike rates. Right now, to the market, the Fed is going to hike rates. You would be dumb to argue that the Fed is not going to hike rates. Now, you might just say, well, that's what I just did. Does that make me dumb? I'm giving you all the reasons from the Fed's perspective why they wouldn't hike rates. But the market says they will. But you have to also understand something about the Fed funds futures market. As you go out in time, they become less and less reliable. What I mean by that, if the Fed funds futures market the day before the meeting says the Fed's going to hike, I will tell you the Fed's going to hike interest rates. We have a long time from now, or not 26 days, right? 20, not 26 days, 21 days, whatever.
Well, we've got a lot of data coming out too.
Right, 20 days. We still got CPI, right? Exactly. Not 21 days. It's the 7th, right? So we got 20 days, roughly.
And the CPI can very well change these odds for sure.
Right. So all I'm saying is I'm not telling you to go out there and fight the market, because at Market Radar, we do not fight the market. We go with the flow. All I'm telling you is there's a lot of time, and we've seen this happen before. The market was pricing, just remember, the market was pricing in a rate hike for the last meeting up until the last week when it fell apart. I'm telling you right now, based on what I'm seeing, and I could be wrong, but I think we have a good shot of seeing the Fed hold rates at this next meeting. Long story short, keep it simple. We want to ride the recession once it's here. We do not want to time the recession.
Otherwise, you end up like Michael Burry underwater for 5 years.
Yeah. And then by the time it works out, you might not have the positions he had, because you have to remember this. Michael Burry won because everything went bankrupt. That's why he won. If he had the credit default swaps, won because they were worthless, right? If he was just shorting the SPY, he wouldn't have made nowhere near as much money. He waited so long for him to walk out ahead. He needed a zero event, right? That's what we call them, zero event, where literally to fucking zero. The thing had to go to zero for him to make money. For example, the SPY didn't go to zero.
Yeah.
Right? And because that went to zero, the payout was so exponential that the time period that he had to wait was well rewarded with the reward from the trade. Nobody here has a zero trade, okay? If you're timing a recession, there's nothing you can buy at retail, a normie, some guy on the street with a Robinhood account that will make money on the zero trade. Remember, Michael Burry's his positions, they were credit default swaps. He had to manually make the market for with these he had to have people manually make the market for him, right? There was no market for this in terms of the position that he was trying to put on. He had to go to the bank specifically for these special types of swaps on the mortgages.
Well, anyway, let's get into the calendar for next week, and let's wrap this up. So next week we do have a fairly decent week. We've got CPI on Wednesday. That's the main thing we're looking for. Take a look at the EFFR futures after CPI, see how that changes, see if we're right. Maybe we'll be right. Thursday, jobless claims. We've got PPI as well. And those are the main things. We've got consumer sentiment on Friday, which will be interesting as well.
Thank you guys so much for listening. If you have any questions, feel free to reach out to us on Twitter at The Market Radar. We have a free Discord. You can join at our website, market-radar.com.